All right, welcome to the NoteWorthy USA Podcast. I'm your host, Ben Fredericks. Today, we are joined by my co-host, Aaron Halderman, and our good buddy, Kevin Shortle. And we're just going to be talking some notes and some different things that are going on in the industry. Obviously, there's a lot of craziness going on right now in the world. And we'll see if we can break down what some of that is actually going to mean for note investors. And, Kevin, we're glad to have you on the show, man. As our first guest for the NoteWorthy podcast. So,
absolutely. Yeah, it's great. Great to be here. I see you got your Cash Flow is King shirt on there. Beautiful. So good, appropriate shirt for today.
Yeah. I try to keep it content rich. So anyway, man, we wanted to have you on just because, of your expertise in the industry and, so you're going to be doing a lot of contributions with NoteWorthy, obviously, but, I figured this is a great time to have an expert, really kind of lay down what's going on in the industry, even though what we're seeing right now is really kind of unprecedented. And, just wanted to get your vibe on it and what you think things are we should be looking out for, what are the opportunities going to be, and we can chat about all those things today.
Yeah, it's 100% unprecedented. You're right. I mean, it's absolutely crazy. And the first part of real estate that is going to be affected, because it's already affected in legislation, is the financial part. And that's the note side of this whole thing. So whether it's government loans, whether it's personal seller financing, that sort of thing, everything is affected by what's going on today, even to the point of recording documentation. Some of the courthouses are closed. I mean, so there's a lot of things going on. So real estate investors in general need to be sensitive to this, but the note investors are going to be the ones impacted first. They're immediately impacted. So that means people who already own notes, you have to know what to do. And it's a great time to prepare for what is most likely to come here in the form of opportunity. And I think real estate investors in general will look at all opportunities, including notes. So yeah, it's a big topic today.
Kevin, you talked about something pretty interesting about, document recording. And, we are definitely in interesting times. I'm just sitting in my third car garage. I got my Peloton bike over there and my treadmill back there. And this is my home office while I got all my kids in the house to do this. But, I have some property taxes in Auburn, New York. Mm-hmm. And, they sent me a notice saying, hey, we're going to take this property unless you can get caught back up on the taxes. And it's coming due in a few weeks. I called them yesterday and literally one ring and I got through to somebody, and I swear she was the only person working in the building. Was excited to talk to me.
Yeah, exactly. How great a person. Yeah.
She was like, what property? And I'm like, 121 East Genesee. She's like, oh, yes. Yeah. And cited off my business. And I'm like, okay, well, I'm just wondering, can I make a partial payment? Can I make my payment later? And she's like, oh, honey, call me back in maybe a month and we'll just see where things are at. And, but you're good for now. I was like, okay. I'm like, okay. Do I need a letter? She's like, no. The governor of New York has put a moratorium on everything. That includes even us claiming properties back on delinquent taxes. And I'm like, okay, so should I call you back in 2 weeks, 3 weeks? She's like, maybe a month, maybe 2 months. I'm like,
it's being done at every level, from city, county to state, and of course even federal level now. But you're right, it has impacts. The initial response from the government with foreclosures and such and evictions was if it's any way involved with a federally backed loan, Fannie Mae, Freddie Mac, FHA, all of that sort of stuff, then they put a moratorium. You can't, foreclose, start within 45 days, rent, and that can be extended, by the way. But that doesn't affect people who own their own privately held notes. But of course, there's the public misconception of that everybody just reads that and they don't see the federally backed part. But we just here in Florida, and I know you're out in California, and Ben's here in Florida with me as well. But the governor of Florida just said, we're not doing any foreclosures. We're not doing any of that. We're calling that non-essential, and some federal courthouses state courthouses aren't even looking at that. So right now, depending upon where you are, what side of the coin you are, the debt coin, if you will, that's everywhere. Everybody's just kind of in hold mode, which isn't a bad thing for either party, I would say, but it's time to prepare, depending upon where you are, whether you own notes or you're looking to buy notes or whatever the case is, and by extension, more traditional real estate as well.
So talk about that a little bit. I mean, what do we do if we own notes now? I haven't actually seen how it's going to affect my notes just yet. I probably won't until sometime next week when, we get our statements and payments and all that.
Right.
But what are the first kind of things that, a note holder should do in this scenario? Like what should we be looking for?
Yeah, it is important, I think, because again, it's just unprecedented. And with the number of people who are unemployed at this point in time, it's a staggering number. It's more than we've ever seen. And you just have to logically think, well, at least a portion of my notes are not going to be paid. But you're right. I've been waiting for the numbers, statistics to come out from how many people haven't paid in April 1st. That's kind of the first time we'll see the initial wave, but many people have until the 10th of the month. Some people's payments until the 15th of the month. So you're right. We got to wait a little bit for the actual data, but I think the logical approach is it is going to happen to at least a percentage of your notes. So my advice is to be proactive. So what I'm telling people is to make sure they number one, be in good communication with your servicing company, right? They're the first ones that are going to know if the payments are coming in or not. And again, you may not be in trouble with the portfolio, but you might be. So let's find that out first. But in the meantime, in anticipation of the probability that a percentage of people aren't going to pay, let's write up a letter. And let's write up one of those letters that you can reach out to the people and say, look, we understand you may be in a situation where you're not able to make the payments because let's face it, a lot of people in the note business as individual note owners, they've been dealing in properties in lower price band, right? Which reflects income and everything else. And it might have a high degree of people in the service industry or small business people that simply can't open their stores right now. And you're going to run into that. So it makes sense to have a letter drawn up that you can send to reach out and modify the loan in a way, if you have to, your rate might go down, but you're doing a goodwill, a good service, which I think will pay dividends better on later on. But I think it's also better if you have, just to use one note example, you have $800 a month coming in from that note and they don't have the ability to pay. Maybe they can pay $400. Maybe they can pay part of that. And I think it's better to reach out and work with somebody and just do a temporary modification, a temporary payment plan where they're paying something versus you don't communicate with that borrower, the borrower doesn't make a payment, and that borrower is just going to disappear on you. They're not leaving the property. What I mean is they're not going to be open to communication. And that becomes a problem 2-3 months down the road because the big unknown we're facing right now is time. How long is this actually going to last? That's the critical component, but nobody seems to have a handle on that, and rightfully so. So my thing is open up that communication with that borrower, and if you can get them working on a plan, I'd much rather have them continue to make payments and stay in that than just turtle shell up and you don't hear anything from them, because that'll be a nightmare 3 months down the road for you.
Kevin, don't you think, and you too, Ben, I think, how can we, it's like we have no choice but to be proactive, because I think there's so much confusion in the media and in various publications online of, okay, do I have to pay rent, or do I, or maybe I don't have to pay rent? Do I, or do I have to pay my mortgage, or do I not have to pay my mortgage for the next 3 months?
Yeah, my friend, he didn't pay his mortgage and he's fine. Yeah, you're going to have all.
Yeah,
they didn't pay their rent and they're still living there. Yeah, it's It's a lot of misinformation. Now, 100% correct. And that's why I think you got to open that line of communication and just make it very clear. If you have a portfolio and you get payments that come in this month, I'm not saying you have to send a letter to them saying I'll adjust your payments down, because some people are working and some people have capital and they can make those payments, but be ready, and if you're not proactive, the borrower or the tenant is not going to be proactive. If anything, they're going to reflect back and just say, well, look, this might be 3 more months and I got to hang on to every dollar that I have. Yeah.
Yeah. A lot of my buddies in the industry, that own rentals, one of the strategies they're doing is sort of akin to what you were just describing, Kevin, in terms of, just doing like a temporary modification, but they're offering discounts on rent, saying, hey, listen, we'll, just pay us 90% of what you're normally paid, and, we'll call it square. And that sort of helps to alleviate their cash flow problem, in the long term, and keeps money going into the bank to make their payments on those properties. Yeah. So.
Absolutely. It doesn't make sense just to sit back and go, well, I guess I'm not getting paid on these right now. I guess I'll have to start, sending out letters or on foreclosure and stuff. That's not going to be the way this one rolls out. Now, again, hopefully the time frame is shortened. There's indicators of that flattening the curve, if you will. And that would be great. If we can get the economy back up and going and it's a temporary couple of month thing, fantastic. But, we should know better this time around after the crash, 2010 and everything, how we went into all these foreclosures and how the system just didn't work. Investors need to be sharper this time around and get ahead of it. Yeah. And that's the whole thing. Yeah.
Yeah. You make a good point there. I mean, how do we get ahead of it? I mean, I've never seen anything like this in my lifetime. Obviously we went through the financial crisis and, that was a different animal than this, right? Here, everybody's going through it. And I think, you had recently written an article where, you showed like, what was that? Like 10%, that only equated to like 10 or 15% of the entirety of the country. And now we're looking at a much larger number.
Oh yeah, the projection. So with a couple of things coming to play here, of course, is unemployment. I mean, we have unemployment numbers now that are absolutely staggering. The first wave of unemployment was 3.3 million people. It was crazy, and then it jumped to 6. So cumulatively, we're at 16 million people have filed for unemployment. Now that doesn't include obviously small business people and things like that are essentially shut down. So you could even really add to those numbers, and that's going to lead to a lot of delinquencies, and delinquencies become defaults, right? So when somebody's delinquent, they're behind, they can catch up. But if this thing rides out 3-4 months, how are they going to ever catch up? They're going to fall, into default, which is putting everything at risk once again. So to your point, in the largest crash real estate financial world that we've ever had was in 2010. And at that point, 10% of all mortgages were in default. And a good portion of those were in serious default, which is over 90 days late on payments. 10%. Now, 10% for those of you listening, you might think, well, that's not, that means 90% are performing. Yeah, but 10%, remember, we're a big country and there's a lot. 10% is a huge number. Well, the projections that they have right now through firms like Moody's Analytics, they are projecting that based upon these trend lines, if things, again, we have an opportunity here, perhaps where this whole virus thing goes more into remission and we can start up again. But if it doesn't, they're projecting that as many as 30% of Americans with home loans, which is 15 million houses, 15 million households, could go into default. And that would be 3 times, what the worst was, right? So we had 10% was the worst. This would be 30%. And it's just a staggering number when you see it on a chart, which I shared with you all. You look at that on a chart and you go, wow, that's going to be massive. And again, that could absolutely hurt property values. It will hurt property values as well. So we have to be, as smart investors, let's prepare for worst case scenario, hope for best, right? It's the same mentality, hope for best case scenario and prepare for worst case scenario. On the positive side of things, it will create more opportunities in the future. And I want to qualify that, by the way. When people go into default and we buy defaulted loans, we're not looking at, oh boy, there's going to be a lot of defaults and we're going to be able to come in and buy these things at a huge discount. That's not the opportunity, the proper way really to look at this, because we can go back once again to 2010 and look what happened. The government realized they couldn't fix the problem because they weren't able to. Banks tried to fix the problem. They weren't able to. Wall Street tried to fix it. They bailed out within a couple of years. It came down to entrepreneurs like you and me that had to come in and buy all these notes up, and we started really curing that problem. So this next go around, our industry, I think, is much better prepared to deal with this. We're going to need more investors to come in, but I think that wave of investors is coming already. You know, we've had those conversations where more and more people are looking at notes as its own asset class. So there's going to be a large amount of people, over 15 million nationwide, that want to stay in their homes, but don't have the ability or the communication because the banks and the government's really not set up to do that. Investors like you and I, we're going to be there to save the day with this or overcome the problems.
Yeah. By the way, I mean, that's a great plug for getting in tune with something like Noteworthy or, you know, with mentoring in the note industry. Like if you're an investor and you've been sitting on the sidelines and you don't know a damn thing about notes, it's a good time to start learning, because there's going to be, what you just said means translation, large opportunity on the backside of this thing for people that are educated to come in.
Yeah. And unlike the previous crash where it happened very quickly and nobody was really prepared for it, this one, you're seeing it unfold right in front of your eyes, right? We know people can't go out. We know the restaurants are closed. We know, you know, I'm here in Orlando. We know the theme parks are closed. The whole Central Florida area, which you and I have been a little bit more sensitive to, it's all service oriented, and all these small businesses are closed. I mean, it's just a crazy what's going to happen, and it will just go down that road. You're right. So if you're an investor who's been sitting on the sidelines or sitting on capital wondering, what do I do? You know, cash position's not going to cut it, right? They cut interest rates all the way down to nothing. So sitting on cash is nothing. There's going to be opportunities for IRA funds and everybody else. I mean, if you took a lot of the capital that's sitting on the sidelines right now in self-directed IRAs, billions and billions and billions of dollars, even small accounts will be able to invest in notes in the future. And that could be one of the biggest components that props this up and really enables people to stay in their homes, albeit under an adjusted mortgage.
I think a lot of people are, you know, you kind of see two ends of the spectrum. You see a lot of people right now that are like, everything's on hold and they're just kind of waiting and looking and observing. And then you have other people in your ear that are making a bunch of noise and saying, you know, don't be sitting on the sidelines. Now is the time to take action. Now is the time to do, you know, so you kind of have it at both angles. I think one key point to like bring it full circle is this situation that we're dealing with right now was not caused by credit or bad loans.
Correct.
Or a crash in real estate or over leverage.
Yep.
This isn't a real estate bubble. This is something that we haven't really experienced in any of our lifetimes on this podcast. And so as a result, I haven't seen any media discussions at all that's discussing the investors, real estate investors specifically, not being able to get loans for fix and flip, for construction. They've all closed their fundings until further notice. Finance of America Commercial, the largest, closed it like 2 weeks ago until further notice. You know, so what we're seeing is going to be a total lagging factor. You know, we're not going to see media on it probably for another couple months. We're not going to see any whisperings of default. You know, and that's where Kevin, you and Ben are mentioning, you know, the opportunity. It's like, well, now is the time for us to get educated, get prepared, get our capital in place or other investors in place for when this does finally hit, and it will hit, because those 16 million and growing, they're out of jobs. They're not going back to work in 2-3 months. Right. They're not all getting hired back.
Right. Right.
You know, that's what's, and that's heartbreaking too, to even say that and even think about it. But that's just the fact, is the businesses won't be in a position where they've recovered. And I was on a call earlier this morning on the Paycheck Protection Program, and then the Economic Injury Disaster Relief, the EIDL. I've heard very few people that are even getting any of those checks or advances. You know, one of my buddies got $15K on an SBA loan, and he was needing $150K. He got 15. You know, so I'm just like looking at all this as like, it's coming. It's not being advertised on the media yet, but for those of us that are on the back end, you know, and in the trenches, we know what's coming. You know, and it's going to be real interesting to see how it plays out. Like most of the non-qualified mortgage, it's called non-QM, you know, they're not doing any fundings. They're not doing investor loans.
No, you're right. And, you know, I walk around, we're still allowed to walk for exercise around here and such, and there's nobody around. And I'm just looking at all these small businesses wondering, geez, I wonder how many are going to be able to reopen. Because a lot of those businesses, you're right. I mean, they're on a month to month, you know, they've got enough money to carry them for a month. And after that, you know, they've got to close doors. And, you know, going back to the investor side of this and the educational side of this is, you're going to have to, real estate investors, all real estate, you're going to have to be nimble. You're going to have to be smart, and you're going to have to move quick. And that's an advantage that we have, but you got to be sharp about it. You got to be educated about it. It's not business as usual. This is completely different versus the disadvantage that some of these bigger funds have. You talk about businesses and lenders going out. There was also 4 extremely large real estate investment trusts essentially run out of capital, because they were doing everything on margin. So what happens? Well, you've got a fund with $100 billion real estate investment trust that's buying mortgages. And what they do is they pledge their portfolio as collateral and borrow against it. They make great returns when the market's doing well. But what happened? Well, the unemployment numbers come out, you know, all these smart lenders that lent on the portfolio, they look at this and say, well, wait a minute, those notes are not going to be worth as much as they are right now, because a percentage of them are going to turn to non-performing. We need more collateral, which means a margin call. So they all got margin calls, and they don't have the money. Yeah, they're begging for a bailout right now. They don't have the money. They're not nimble. And that's one thing as a small investor, you listening to this podcast, we can be nimble. We can move quicker. We can do things that they can't do as efficiently or effectively. And that's why eventually it's going to come back down to us again, and being prepared right now and becoming a student of the market. It just makes sense because it really will open up avenues that investors never seen before.
I don't know how many people really understand, Kevin, what you just mentioned, but people often hear the words warehouse lines. Mm-hmm. I don't think people really understand that, but you know, if I were to try and oversimplify it for a minute, you know, let's say the 3 of us just set up a business, you know, our own mortgage business. And we're going to go and fund investor loans. And we have this warehouse line where, you know, let's say it's 50 million and we had to put in, you know, 10% of our own capital, 5 million into it. And we got 45 million of leverage from Chase Bank. Okay. Mm-hmm. So that's sitting there. So we go originate our own loans. Okay. With that warehouse line, and our end buyer is that REIT that Kevin is talking about, where they're giving us, you know, XYZ number of points based on that warehouse line. Well, if they can't sell the mortgages that they've accumulated by spending that warehouse line, they have to keep it on their balance sheet. And guess how much money they've made? None, because they don't have an end buyer. And then couple that with the margin call, through Chase, it's like, hey, well, we got to call this due. And if they don't have the liquidity, they're out of business.
Yeah, they lose all their assets. They pledge their assets as collateral. They're done.
That's what that means.
Yeah. And then in your example, then Chase takes all that back. What are they going to do? Are they going to hire 20,000 people to call all these borrowers and do loan modifications? No, they're going to package it up and get rid of it. Yeah.
And therein lies our opportunity again.
Yeah.
So talk about, I've had a lot of people approach me this week, just to segue a little bit into, is it a good time right now to be buying or selling a note? Like, should we be doing that, or should we be in a hold position and see, all right, exactly how is this going to shake out? What's your opinion?
Well, it's still a good time to buy because, again, there's a variety of different types of notes, right? So if you're an investor who's going to be more active and you're looking at non-performing notes, not a whole lot of changes there, right? It's not performing already. You're not going to have any surprises there, right? So it's not performing, and you won't see as much as a price adjustment on non-performing notes right now. Performing notes, you can still buy, but you're probably going to get a little better price. If the prices haven't changed right now, it's likely that they will in a couple of months. Why? Because once again, there's going to be a percentage of these loans that become non-performing. So a smart investor is going to go, if I'm buying a performing note, I'm going to assume in the environment that we're in right now that it may go sub-performing, at a minimum non-performing, at a worse, and I'm going to invest properly. So I'm going to look at my risk factor there, and I might lower how much I'm willing to pay for that note. And we haven't seen the price changes on that just yet, but inevitably that's going to happen. But let's see what the numbers say. Did the people make the April payments? Are they going to be able to make the May payments? So as quickly as 2-3 months down the road, I think you'll start to see an adjustment where some notes go sub-performing, which again makes it more of an attractive investment. Because if I can come in and I buy a note from a larger company that's not as nimble, I can come in and buy that one note. I can take that proactive step that we were talking about earlier and reach out to those people and say, hey, look, we understand, we're all dealing with this pandemic. Here's what we're willing to do for you, and get that note under a trial mod. That, that's going to be a benefit to them. And of course, it's going to be a benefit to me, and I'll still be able to make my profits on that. We've also seen an interesting phenomenon with my friends over at PaperStack. I had a call with them recently, and they've seen an increase of over 30% of the number of people that have gone to their website to look at notes. These are new people that have registered for the first time, and they noticed that a lot of them were hard money lenders. A good percentage of them were hard money lenders that don't have anybody to lend to in the more traditional real estate right now.
They need cash flow.
Exactly. They don't have the fix and flippers, because fix and flippers are going, what do we do now? We can't get as much money as we need. What's going to happen to the properties? What are we going to do with it? So the hard money lenders who need to deploy capital are looking at, well, instead of us doing a loan, let's buy a loan that's already been originated. So that's kind of interesting as well. But I think it still goes on. You just adjust how much you're willing to pay.
I concur, doctor. Like Catch Me If You Can, Leonardo DiCaprio. Making to be a surgeon. I concur. What do you think? I concur. I think something interesting on that point too is I think it really comes down to people's anytime people are panicking or fearful of what's going on in our economy, what is it that they always want to get into? Liquidity. They want to bring things back into cash, and they want to be sitting with their liquidity for a rainy day, for when like shit really does take a dive, if it does, when it does. So to your point, Kevin, I think now is a good opportunity on those paying assets to get those at a discount, because why would anybody be selling those in the first place? It's because they want to bring it to cash. They need liquidity either for their existing business, or they're just fearful and want to be sitting in cash, period.
Oh, totally. And the other approach, and I've been doing consulting calls like crazy right now in my consulting note business. for obvious reasons. Everybody's asking these same questions, and I'm really directing people and letting them understand, look, there's, as I've always said, there's 3 different funnels that we can tap into for marketplaces for notes. And the one that's been ignored over the years is the so-called mom and pop. These are just somebody who owns a note simply because they sold their parents' property and took paper back, or maybe it's a small investor who owns 1 or 2 notes. Those people, in many cases, are also going to need cash. Yeah. And it doesn't even have to be you that buys those notes. Now, we can find those people through lead lists and such. We reach out to them. In fact, I've written a couple of new marketing letters just targeting that particular audience because I know some of those people are going to need cash. It doesn't even have to be my money because we still have big buyers in the business that are financially secure and are buying these assets, and we can put the 2 together. So that's a great opportunity for buying notes right now, where you're not going to a trading platform. You're actually reaching out to just the average person who happened to sell a house and carries back a note. And now they go, wow, now I can get, maybe they don't want to sell the whole note. Maybe they're just like, man, I just need 30 grand to cover me for the next 2-3 months. And they can sell that much of the note. So there's even opportunities right now to tap into markets that people haven't thought about before.
Yeah.
Do you think there's sort of, and to use, I'm very sad that, we might not get baseball this year.
I saw that on your social media there.
It's borderline depressing.
I also saw you're not a football guy, huh?
No. Well, I won't sit around and watch football just to watch football, which my wife loves, by the way. Yeah. But if my team's not playing, I just don't care. It's no big deal. And my team sucks. So it's pointless. But
you're a Dolphin fan too?
No, I'm even worse. I'm a Bears fan. So to use a baseball reference, in terms of just the Mendoza line, when you're looking at notes, there's sort of that, and you mentioned it, and saying, all right, well, performing notes, you're probably going to get a little bit better pricing, right? Just because there's that uncertainty of what's going to happen. Sure. And I see this in the wholesale side too, where wholesalers are saying, well, they're going to build in typically, a bigger margin of error into their offer there. Do you have some sort of a number in mind for that, where you say, all right, this is where if I'm going in to make an offer, this is sort of my starting point now because of this environment?
I don't have a drill down on where those numbers are. I think it's too early, like I said, for that. We really haven't seen what the performance rate is in April just yet. Based upon that, might come up with something. But even the biggest buyer I'll go back to the mom and pop notes. They bought 80 million in notes last year. And so they're a popular or a big buyer in that industry, just buying these one-off notes. And they've lowered their maximum investment to value ratio, which is the mechanism, the math that we use, the ratio we use to cover our risk. They've lowered it down now to 70%. So when, for example, if you sent me a note that you own to buy, I'm not even looking at yield first. Your note could be written at 11%. I don't care. I'm not looking at that number first. I'm looking at what's the property currently worth, and the most I'm going to be in that note is 70% of that. Okay. So that gives me that margin of error where if the property values goes down or the note goes bad and I have to take the property back, I've still got margin in there. Okay. So they were on performing notes. I mean, as early as last year, people were getting upwards of 88 cents on the dollar ITVs, 90% ITVs, much higher risk, but property values were going up. So already there's been an adjustment from a bigger buyer. And that bigger buyer, by the way, has been in the business for 45 years. So they've got stats, they know what's going on. So it's a good little, for those listening, a good guideline for you that I gave you right there. That'll keep you safe.
So I got two comments to make on that. One is, some of the lenders that are still lending are looking at 50 to 60%, ARV, LTV, but that's where they're at. they're like 50% now to lend on anything or refi or do a bridge loan. What they said on appraisals, that were done even a month ago, just go ahead and whack 3 to 5% off right now for what we're looking at, and that's just what I've been told by some of, the decent sized lenders here in Southern California. They're like, all right, so if it was 750, we're going to be looking at like 715 now, that's really what it is. And that's how we're going to base off what we're going to lend to you off that number. Now, they're not saying 10% or 20%, but we're definitely looking at 3 to 5, points off of that most recent value that you got.
Right. I'm sure they're looking at that on a regular basis, subject to change. Yeah.
And that's really incredible, because that's like a year's worth of appreciation chopped off in a couple of weeks.
You got it.
Yes. Yeah. So if that's any foreshadowing indicator of like, now they're also, I hope, and I feel like, I'm an optimist, but also very much data driven as an optimist. And, I hope that's where it goes to and where it stays this year. I hope that's all. We just lose like a year's worth of value. That's where it's at. We recover, but preparing as if it just keeps plummeting, so, yeah.
Yeah. So Kevin, tell us, share a little bit about what you're doing to prepare yourself for the backside of this, right? So what are you working to get lined up now so that you can take full advantage of this, when we figure out where exactly this goes?
Yeah, inevitably, non-performing notes are going to come back in a bigger fashion. Non-performing notes have been on a slow decline over the years as far as inventory levels, because again, our industry is part of the solution. So we're ourselves as investors chipping away on that inventory. So it's a positive thing in an overall marketplace. There's always a baseline of non-performing notes, just like there's always a baseline of foreclosures, but whether it goes to what Moody's projected, where you all of a sudden you go up to 30% of all mortgages, or maybe it just goes up to 10% of all mortgages. Again, even if it does 10%, look what happened to the inventory levels. We're talking billions and billions of dollars worth of non-performing notes. So even if it just hits that, it's this whole other wave that we'll be working on for the next 8 years. Because we're still working on notes from the first wave of this back in 2010. I mean, there's still inventory back from those days. It's getting smaller, but if we project that this happens again and it's a repeated cycle, we're going to have inventory levels that'll go out, which means it'll mirror the same thing that happened before, which was the prices on non-performing notes will probably drop down to 20 cents on the dollar. Okay. That's an opportunity that all investors have to look at. I mean, if you can buy real estate backed, remember all of these notes are backed by real estate, right? So if you're in your collateral for only 20 cents of what it's worth, that's an opportunity that all investors have to look at. And that's going to bring more people into the business. I believe, especially if it goes even higher than the 10% default rate. So right now, I'm just keeping an eye on those numbers. There's really no way of knowing where we are right now, but it's time to sharpen the saw and knowing how to do your due diligence. So in my case, I mean, consulting, I'm helping people with that every day. So I don't know if I'm personally doing anything a little bit different, because it's going to come down to, all right, of these notes now, how do we do our due diligence and what's our exit strategies? But those are two things that are absolutely learnable skills. And obviously been teaching that for a long time. So it's just going to come down to that. And who knows, there may be some new exit strategies that happen down the road that we haven't thought of yet. So that part I don't know, but I would say if you're interested in the business, yes, education. If you're already in the business, you know what? You may want to dust off some of those books and go back and read a little bit about the non-performers and such. A lot of investors, for example, switch to performing notes for a number of years now, which is totally fine, totally get that, and may want to continue that. But I think they're going to find that they're too attractive on the non-performing side, again, if prices go down to that. And IRA people, I mean, Aaron, you work with a lot of those folks. I mean, man, if you've got small balance accounts, if you have big balance accounts on that, you're looking to diversify your portfolio. I mean, Jesus, I just don't let that money sit in cash positions. There's going to be good opportunities.
Absolutely. Yeah, we're doing a little virtual summit that out of a professional studio. So we're not just doing like a little Zoom meeting, kind of like in our basement, like we're doing right now. But you can just go to sdirasummit.com, and we're doing that the 17th and 18th of next week. So just myself, Matt Sorensen, and Mark Cole.
Mm-hmm. Yeah, it's worth learning about it. It amazes me how many people with IRAs still don't know all the various investments they can get into. They haven't explored them enough. And boy, if you got time now, do it.
Yeah. It's amazing what you can sit down and learn when, well, first of all, if you've got kids, it's difficult because they're managing most of the day. So I have a whole new respect for teachers and everything that they do. Not that I didn't before, but it's like to the third level now. It's huge. So it takes a lot of time and patience. But if you can work in some additional ways to come out of this with a head start, by all means, do that, because I think Kevin mapped out two great things there, just due diligence and exit strategies. And probably the other thing I'd say on the back end of that is if you're coming out of this on the back end with no money, learn how to raise some,
Mm-hmm.
So if you can just figure out those two or three things, you'll be in a good position to take advantage.
Yeah. And for example, I've been telling some investors, I'm like, look, why don't you put together a sample report of a good note on what you could find somebody, and that's what you're going to use as a tool, a mechanism to give to somebody, whether that's a physical printout or a PDF or what have you. Give it to investors now to look at and review and ask questions about, and start thinking in terms of what you just said there, Ben, is, hey, if you need capital, let's start working on that now. Show them what's coming, show them some stats, show them what a deal looks like, show them why they want to get involved in that. Great opportunity for that.
Yeah. Well, awesome, guys. We've been talking now for almost an hour. So,
oh, wow.
Yeah, it's a good little podcast. I appreciate you coming on, Kevin. Anything you guys want to plug or add?
Yeah, just come see me, realestatewithoutrenters.com or kevinshortle.com, either one, realestatewithoutrenters.com. And if you're looking for education, I've got that. If you're just looking for consulting, doing that as well, working with people one-on-one, which I think is going to be a game changer, in this industry.
Go get Kevin's book, Real Estate Without Renters. So you can get it on his website or on Amazon, but for sure.
Put that in the show notes. And then, by the way, Kevin is going to be doing some contributing for us to the NoteWorthy newsletter, which we'll be releasing here come the first week of May. So we'll have some details coming on that. But he'll be a regular contributor. So if you're going to have questions, we'll make a way for you to reach out, and it'll be sort of like a Ask the Expert type of column where Kevin can answer your questions directly through the monthly newsletter.
Yeah, I would love that.
Awesome, man. Well, thanks for joining us. I appreciate it. Everybody stay healthy. Best to you and your family, and if you're out there, just keep getting educated, stay safe, and get ready, because I think like any major problem that we face, on the back end of it lies tremendous opportunity. And hopefully, you can put yourself in a great position to take advantage. So until next time, we'll catch you on the NoteWorthy podcast.
Talk to y'all later.